Every day, thousands of people pay into an industry built on the promise of easy money. Social media is saturated with ads featuring rented supercars and screenshots of flashing green numbers, all promising a single course or trading challenge is the key to escaping the rat race. But beneath the marketing, this $12 billion industry functions as a mathematically rigged trap. When you look at the data, the survival rate is chilling. These proprietary trading firms rely on a statistical certainty known as gambler's ruin to guarantee that most participants fail. Out of 1,000 people who attempt these challenges, the system filters down to a tiny 7% who manage to turn any profit at all. This chart shows the actual financial outcome for those elite few who survive the algorithmic traps. The average return for a successful retail trader is a mere 4%. To put that in perspective, you can achieve that exact same yield with zero risk and zero stress simply by buying United States Treasuries. It is the definition of getting paid to do nothing. Yet the internet rarely promotes it because boring stability doesn't sell Discord subscriptions. The true business model of these firms isn't to produce successful traders. They are designed to collect non-refundable challenge fees from the 93% who fail. They do not want you to succeed. They want your entry fee to become their revenue. Buying into these courses doesn't grant you a high-income skill. It simply turns you into a source of capital for a system that is mathematically engineered to bleed the majority of its participants dry. True passive wealth isn't built by guessing the next meme stock pump or chasing volatile trends. This is the result of disciplined accumulation of productive assets over a 5 to 10-year horizon, requiring either massive upfront capital or intense upfront sweat equity. The starting point for understanding this entire process is the absolute foundation of global finance, the United States bond market. Legendary hedge fund manager Ray Dalio often describes the bond market as the definitive backbone for all other financial markets. It sets the baseline against which every other investment must be measured. When you buy a treasury bond, you are essentially financing the United States government. In exchange, they provide a guaranteed fixed yield. You are lending your capital to the printer of the global reserve currency. This interest payment is the ultimate risk-free passive income stream. It requires no charts, no courses, and no active analysis, proving real passive income is often found in the most stable, unexciting corners of the market. To aggressively outpace inflation, investors move into the equities market, specifically through broad market index funds. Today, roughly 63% of all United States stock funds are held by passive indexers, a $13 trillion pool of automated money. This chart illustrates the mechanical logic of market cap weighting. As a company grows and becomes more successful, the algorithms governing the index are mathematically forced to buy more of its shares. This creates a massive automated feedback loop of liquidity. The beauty of this system is that it requires no human intervention. The engine automatically buys the winners and purges the losers, compounding your capital year after year. The historical result of this mechanical system is stark. Over the past 17 years, the S&P 500 has delivered cumulative returns of over 715%. Participating in this growth doesn't require a masterclass or secret stock-picking skills. It simply requires the patience to let the mathematical certainty of the broad market do its work over time. Value investors like Warren Buffett take a different but equally methodical approach, focusing on blue-chip stocks and real estate investment trusts, or REITs. These are assets with deep economic moats that generate quarterly checks for their owners. This is a mechanical transfer of corporate profits directly into your brokerage account. However, building a portfolio that spins off livable cash flow requires years of active labor to first accumulate the necessary capital base. Cryptocurrency is often marketed as a similar digital asset, but it lacks the same mechanical foundation. Unlike a business or real estate, it produces no cash flows and pays no dividends. Its price is driven primarily by speculation, relying on the hope that a future buyer will pay more for it than you did. The risks of this speculative model were demonstrated in May of 2022, when the algorithmic stablecoin Terra collapsed. $45 billion of investor money evaporated in a single week, one of the largest destructions of wealth in modern history. Without the underlying architecture of cash flow, these assets often become graveyards for retail investors, who provide the liquidity for larger players to exit the market. We are seeing a widening gap in the economy. On one side are millions of people trapped in active financial decay, financing their survival with credit cards charging 22% interest. On the other side are the passive investors who understand the mechanics of compounding. They are the ones steadily accumulating index shares and locking in yields while the automated machine of the market does the heavy lifting. When the market pulls back, which historically happens about once every 3 years, the retail army often panics. Because their portfolios are built on hype and leverage, they sell at the absolute bottom. But the true passive investors wait. They understand that when the liquidity crunch hits and the gamblers are wiped out, the ones holding productive assets will be the only ones left standing. The math of wealth construction is clear. There are no shortcuts. Financial freedom is the result of the boring, relentless application of capital over a massive time horizon. The next time someone tries to sell you a secret strategy for getting rich, ask yourself, if their system is so profitable, why do they need your money to teach it? Guard your capital, trust the math, and accept the reality that getting rich slowly is the only way to stay rich.